Hello class, and welcome to the second video in this unit. The last video we talked about deferred tax liabilities, so this one we are going to talk about deferred tax assets. Quick review about what deferred tax liabilities and deferred tax assets are. So the reason we have this is because of the difference in GAAP, United States GAAP, the generally accepted accounting principles, rules we use to determine our net income, and what the tax laws are, the rules that are used to determine our taxable income. So there has to be a way to reconcile that for financial reporting purposes. When we go to reconcile this, there are temporary and permanent differences. You might recall from our last video, the permanent differences are stuff that never reverse. We just ignore and lower our taxable income. The temporary differences are differences that occur because of timing issues when the different rules and regulations say you're allowed to get the tax exemption or when you have to pay the tax on revenue. So whenever we have those temporary differences, we make our adjustments. If net income becomes greater than taxable income, that is going to create future taxable amounts. That is a dollar amount that we are doing. That is always a dollar amount. When you take that dollar amount, that is future taxable amount, whatever that is, you multiply it by the tax rate, that gets you a deferred tax liability. Whenever net income is lower than taxable income because of the temporary differences, that becomes a future deductible amount. Future deductible amounts multiplied by the tax rate is what we record as our deferred tax assets. Okay, so we went through the video and we did two examples of deferred tax liabilities and what they were. In this one, I'm going to go through an example of a deferred tax asset, and you're going to see that the accounting and the procedure is exactly the same for the deferred tax liability, only it's going to be on the other side of the journal entries and the T accounts because it is an asset instead of a liability. The things that create deferred tax assets. So unearned revenue. Unearned revenue is just that it's a liability for financial accounting purposes. But for tax purposes, whenever you receive the cash is when you have to report that as income. Okay, so that is going to make your taxable income higher because you're going to have more revenue. There'll be a temporary difference because in the future years, that's going to reverse out. That unearned revenue will become earned revenue for financial reporting purposes, but there'll be no cash involved, so you will not be taxed on it. On the other side, the losses, the main losses we're going to worry about are contingent losses. That was done back before we took semester break, I believe in chapter 14, yeah, when we talked about liability. So contingent losses, things that may or may not happen, but they have to be, remember, it was either possible, or remote. So whenever it was probable, you went ahead and you recorded it as an expense and as a liability, things like the warranties and the asset retirement obligations and maybe a lawsuit, stuff like that. We have not paid out any cash yet, but we record them as expenses. Well, for tax purposes, we cannot expense them until they are actually paid. So again, if we're eliminating expenses, that is going to increase our taxable income. And the second thing on there is the unrealized losses. That was whenever we did the fair value adjustments for the securities that were short term, and you get unrealized gains and losses, or maybe from the pension benefit obligation that we just did in the previous chapter. There's some unrealized gains and losses, quite a few different things that are a little more advanced than what we're getting into, which those unrealized losses will create a deferred tax asset. So let's work through a problem here on deferred tax assets. So our problem states that we have pre-tax income in year one of 120, in year two of 100, year three of 100. In year one, we sold products that contained a warranty. We estimated an 80 warranty expense for year one. Okay. These are facts that are given to us in the problem. This is what's on our slides. Okay. But we were also told that 36 was paid in year two, and 44 paid year three. And when I'm saying paid, I'm meaning that the it was actually the warranties where stuff was brought back on the warranty and the company had to pay whatever it was, whether it was labor or parts or whatever it was to satisfy this warranty requirement. But they expensed it all in year one, and it actually got used in years 2 and 3. Okay. So it is the same process we use for deferred tax liabilities. The first thing we want to do is find our taxable income. So we do not have any permanent differences. Remember, taxable income, you start with your net income. So there's our pre-tax income, our net income, 120. Add or subtract out any permanent differences. We do not have any. Add or subtract out any temporary differences. Well, in this case, we have a warranty expense that we are not allowed to expense because there was no actual cost. So we have to, for year one, 120 plus 80. So our taxable income becomes $200. Tax rate, 25%. Take your taxable income times your tax rate. You remember that becomes your income tax payable. So for year one, you have an income tax payable of 50 as a credit. The second step was to calculate the ending deferred tax asset. Well, right now, our future deductible amount is the 80. That is the temporary difference. The dollar is still there at the tax rate. 25% gives us an ending deferred tax asset of 20. We would plug that into a T account, but since we have no beginning balance, that is what it is going to be. That's going to be the journal entry because it is the adjusting entry, but there's no adjustment when it first starts. Deferred tax asset of 20. And finally, the income tax expense, just as in the other process for the deferred tax liabilities, is just a plug number to make our journal entries balance there. So we have an income tax expense of 30 for year one. So that's how you would calculate the deferred tax asset and record it for year one. In year two, we start with our net income of $100, but it told us that $36 of warranty expense was actually paid out, or we did the work amount of that. So we can lower our taxable income because now we get to deduct it. 100 minus 36 gives us taxable income of 64. Multiply that by the tax rate of 25%, we get 16. Remember that 16 is our income tax payable. Okay. So there's step one. Net income. Take out the temporary difference. It's going to be recognized as period to get to our taxable income. Gets us 16. Okay. The next step, we have to look at our future deductible amount. Well, we were going to be able to deduct 80, but now we've already used 36 of it. So we only have 44 left that we can deduct. Times the 25% gets us 11. You remember that is our ending DTA. So we have to take that number, plug into the deferred tax asset T account here. We started it off, we created it, we had 20, we need an ending of 11. So in order to make it balance, we need to do a credit entry of 9. That's what we will do in our journal entry here. And always the last one, income tax expense, is a plug number, and it is 25 in order to make it balance. So there is your journal entry for year two, how you would go about calculating. For year three, start off with 100. Well, we're going to subtract out 44 because that is the amount of temporary difference that reversed this year, giving us taxable income of 56 times the 25% tax rate for a total of 14. Income tax payable of 14. We now have 0 left in our deferred or for future deductible amounts because we had 44 in year 2. We have taken it all. 0 times 25%. 44 that we had in there minus the 44 we used. That's 0. Plug that into our T account. We had what was our ending balance before? It was 11. We need to 0. 11 is the number. And plug in the income tax expense again. I'm not going to go through another example of this because if you see the deferred tax liability, the deferred tax asset, you watch the other video, the process of going through these is exactly the same. Okay? Difficult part is identifying what is the permanent differences and what exactly are the temporary differences, but I'm going to have your charts with you that I gave you on the last video and what is going to be, you can find on the slides, I forget the number already, but it's on there, it lists them out, what is what and what creates what. Okay, so there is one other little thing here that goes along with deferred tax assets. And that is evaluation allowance. Now the concept behind evaluation allowance is the same as like in an accounts receivable. We're recording and putting our accounts receivable on our balance sheet at the net amount, what we expect to receive. We're taking into account bad debt expense, right? People aren't going to pay us. Along those same lines, sometimes companies could have a bunch of deferred tax assets built up, and they realize they may never actually realize the income to be able to recognize some of these deferred tax assets. So in that case, they're going to want to write down their deferred tax assets. They're going to do that by using evaluation allowance account. Okay. Whenever we make a journal entry, it is always offset by income tax expense. Okay. So whenever we create, and I should say this, and it can be adjusted. Because whenever we create it and we're lowering a deferred tax liability, it's going to have to be a credit. So when we offset it by income tax expenses, it's going to have to be a debit. Debits create our expenses, so creation of the valuation allowance is usually going to increase your income tax expense. But throughout the period, it can be adjusted. So say you thought you were going to recognize, or you were not going to be able to use some of that deferred tax asset, and all of a sudden, boom, the economy picks up. You have a great year, your income, your taxable income, everything's increased, and you use up more of that deferred tax asset in this following year than you thought. So maybe you reevaluate, and then you're going to make an adjustment. And you're going to say, okay, well, now we assume that we're going to get to use most or all of this deferred tax asset or whatever amount it is, and you adjust it. And in that case, it could actually, when you're putting it back on the other side, taking that valuation allowance lower, could make your income tax expense go lower. All right, so just an example of this. Company has deferred tax assets equal 8 million, and they estimate 3 million will not be realized. Go to making a journal entry. And that is all it is. Whatever you estimate that you're not going to receive goes into the valuation allowance for the deferred tax asset. It increases your income tax expense. The offsetting journal entry is always income tax expense. Okay, so as I said, what if they had a great year though? And then the next year, they only estimate they had a great year, they use up a lot of that. So now they only estimate that 500,000 of this deferred tax asset that they had built up is going to be unrecognizable. We go to our valuation. That account right there is what we're looking at, okay? We've had it at 3. Our next year estimate is 500,000, so that's 0.5 million. We need to make an adjusting entry of 2.5 in order to get that valuation account set right. So in year 2, the journal entry is actually going to be a debit to your valuation allowance DTA of 2.5, and it is actually going to lower our income tax expense with a credit by 2.5. Okay. One important thing to remember than this is not a very high threshold to create this valuation allowance. It is just more likely than not. So basically, if it's 50-50, 51%, that makes it more likely than not happening, or that you're not going to realize it, okay? So this is numbers that do give management and the accountants a little bit room for flexibility. If you're going to evaluate performance and you're going to be looking at financial statements, you might want to dig into these little bit numbers and see how they get this valuation allowance. Okay, because they could be undercutting it, they could be overcutting it, and it definitely affects what is produced in net income by the big effect it can have on income tax expense. So that is kind of all about deferred tax assets. I'm going to cover one last thing in this video, because as I said here, some things can have a big effect on net income. Well, one of the things that can have a big effect on net income is when tax rates change. Okay, so anytime we're doing deferred tax assets or deferred tax liabilities, it is always recorded at the currently enacted tax rate. If there is a guess, or even if you're 95% certain that sometime in the future the tax rate's going to change, you cannot make that change until the tax rate is actually enacted and it makes the change. Okay? When it does make a change, you must immediately adjust your deferred tax assets and your deferred tax liabilities, and the effect is reflected in operating income in the year the change is enacted. Kind of important now, especially if you're doing some financial statement analysis, because we just did have a big tax cut in the Tax Cuts and Job Act. The corporate rate went from a 35% to a 31%. Okay. So let's see how does that affect companies? Well, shows in your slide, it gives a good example of Citigroup and Verizon, okay? When it came in, the companies went through and they found out what their taxable income would be. Net income, taking out the future deductible amounts and the future taxable amounts, adjusting for that, get our taxable income. Then you have to multiply that by the tax rate, which at that time is still enacted, is 35%. The deferred tax assets and the deferred tax liabilities were going to be moving forward in future years. The law had already been passed, it has been enacted, so in future years, the tax rate was going to be 21%. So after they found the adjusting entry adjusting future deductible amounts, they're going to adjust all that to 21%. It is going to make a huge, huge difference in net income because it is a change of 14%. For example, Citigroup net income went down $22.6 billion. They had to reevaluate the deferred tax asset. They had a huge amount, so all this benefit that they thought they were going to get, they thought they were going to get all this stuff built up at 35%. Now it's all built up, they're only going to get it at 21%. So it's a little bit of a loss for them. But on the other hand, Verizon's income went up by $16.8 billion because of a reevaluation of all their deferred tax liability. So they had all this built up of future payable amounts, future taxable amounts that they thought that we're going to have to pay at 35%. Now all of a sudden they have to pay it at 21%. So it really affected their net income through income tax expense. Okay. So you have a problem like one of those on your homework. I'm not going to go through one because it is all it is you find out what the different number is. So if we had, I'll give you a quick example. 1 million in deferred tax assets at 35%. So I should grab my calculator. So we have 350,000 in deferred tax assets. When the tax rate changes, we still have the same future deductible amounts. We still have $1 million, but now when you multiply by 21%, you get 210,000. Adjusting entry there of 140,000 to a deferred tax asset, lower it is always offset by income tax expense. So as you can see, an adjustment for this minimal amount here of deferred tax assets makes a minimal effect to net income. So it's just something to keep in mind. It's good for you. I mean, you're gonna have to know how to do it for your exam, so definitely keep it in mind for that. But it's something to keep in mind, especially looking back through companies' financial statements for the past few years, especially between 2017 and 18 when this took effect. And just you can't trust some of that net income numbers in those times. They're just not comparable because of these amounts. They just take a little while for it to settle out. All right, so I have one more video for you in this chapter where we're going to work through a problem where we had deferred tax assets and deferred tax liabilities mixed together in the same problem. And then, let's see, I believe there's one more thing. Oh, net operating losses and the carry forward and the tax consequences with those. But we'll get into that in the next video, which will be coming out probably either on Thursday or Friday. All right, talk to you guys later.